Thank you for joining me on another episode here. This is an absolutely incredible episode. Crazy story. I get to interview my friend Dylan Marma, who's the CEO and founder of Requity Group. This is absolutely insane, guys. He's 29 years old. He owns this firm. He started this firm and he self-manages and built up to 2,500 units. He's raised over $50 million. He drives a $5,000 car and is extremely humble, like one of the most humble guys I've ever met in my life. It's just an absolute blast. He doesn't really hold anything back on the episode. And a couple things that I love about Dylan is that he doesn't really post on social media. So he's not posting clickbait. That's certainly not in the guru space. He really just reminds me of when I was in the Marine Corps. I was deployed on a Navy ship and working a mission with some guys. And I basically had to pry it out of these guys that they were actually Navy SEALs. They wouldn't tell me. Like, you would think if you became a SEAL, you would be like, I'm a SEAL, I'm a badass. And so it just a quick reminder that the real operator, the real savages in the world truly work in the dark. And so that's what I love about Dylan. He also drives a $5,000 car. Absolutely love that about him. But in the episode, we talk about how and why he chooses RV parks and mobile home parks, why he's so bullish on them. Basically, we talk about, look, you could own one park and it would be really easy to make it the best experience ever, but it's very hard to do it at scale. But he's building a team and he's doing it and having tons of success. He's actually built out his own property management company. He's not relying on a third party, which for those of you in the real estate industry know that real estate acquisitions and property management are two separate businesses, and it's really hard to grow them side by side. So for him to be 29 years old, 2,500 units, and raise $50 million in such a short amount of time, all of his deals are succeeding. They're all paying out his investors. His track record is absolutely incredible. He started in multifamily, create some partnerships, and really just learned. He understood that he was in his learning season, not his earning season. And he still very much believes that the syndication real estate business is a delayed gratification business. He says in the interview, look, I don't make a ton. It's really just based on delayed gratification. So he's still growing. He's basically also says, like, look, I work 7 days a week and I probably shouldn't be proud of that, but he absolutely loves the dirt. Gary Vee talks a lot about loving the dirt and loving what you do. He lives a very simple life and chooses to spend his money on DoorDash and conveniences that he can buy back his time. It's just really an incredible interview. I can't wait for you guys to listen to this one. Would love to hear any feedback in the end. And thanks again for listening. Dylan, thanks for joining us this week. I just read your bio. Super impressive. You're really young, really hungry. It seems like you're building out some amazing systems and processes and teams within RV parks and mobile home parks. I just want to hand the torch over to you. Tell us a little bit more about yourself.
Yeah, Nick, thanks for having me on the show. Look forward to catching up. It's been good to chat with you it feels like every few months or so in the last couple of years. It's been good to watch your journey. As far as, myself, so today I am the principal owner, founder of the Requity Group. We are a vertically integrated investment and property management company that currently oversees around 2,500 units of mobile home communities, RV campgrounds, and some apartments. So I got my start in apartments, and I guess I've been full-time in the business for coming up to 7 years soon. It feels like it flew by, but definitely really enjoy the business that we're in. I feel like I've worn a lot of the hats between acquisitions, asset management, property management, investor relations, and so on. Based out of Tampa, Florida. Our portfolio is primarily in the Southeast. And that's where we are today.
Yeah, and you're 28, is that right?
I'm actually 29, so
29.
Closing
okay.
on 30 here soon. Yeah.
Yeah, you'll be there soon. I'll be 31 next week, so it goes by really fast. So 28, you own and operate 2,500 units. For the listeners that don't know, what is a syndication? Because you have syndication and you also have funds. So I want to start there. Can you break down a syndication
Yeah.
for us?
Yeah. So, I mean, the way I got started and have done a handful of deals is just like a typical, well, either you're a sole proprietor that owns the entity that owns the deal, the piece of real estate. And then from there, it usually evolves into joint ventures where you and a few partners chip in to get, um, maybe to purchase an asset that's a little bit larger and harder um, to buy on your own, maybe, or maybe you'd rather just spread out your capital to not put all of your eggs in one basket. And then typically, once you have some experience under your belt and you feel comfortable being able to take on other people's money to help, them get a good return and also to help you get an outsized return for effectively being paid to find and manage and operate and achieve a successful venture, then you usually the next step is a syndication. So syndication is effectively, I guess from a legal standpoint, you have a limited partnership and then a general partner that has control over everything. So usually all of the money gets pooled into the limited partnership where all of the investors and usually the general partner will invest alongside them into the limited partnership, or which sometimes can be an LLC that will actually own the asset. And then all of the control rights go to the manager of the LLC or the general partner, who effectively is responsible for finding the deal, doing the due diligence, doing all of the asset management, and either hiring property management or doing it themselves. And then the general partner is compensated. The majority of the compensation is usually from a profit share, right? So after you've successfully executed and performed for your investors, you're able to receive, maybe a percentage of the profits above a certain threshold, to align interests to ensure that you're really there to maximize the value of the property over along the way. And then there's usually a base set of fees that cover operating costs between either an acquisition or asset management fee, that are required to build the team that it takes to effectively manage the partnership and see through the successful execution of the business plan. So that's a syndication, and then a fund is very similar to a syndication, but a fund is usually, most funds are what we call closer to like a blind pool fund, where the investors are investing into a fund that essentially will pool together capital with a general thesis as to how they plan to allocate the capital and what the general target returns are. And then they usually will have a few years or so to deploy that capital. And then from the investor standpoint, they're getting a diversified return of over several deals versus just having high exposure to one individual asset.
Yeah, that's a great explanation. So I want to get into the fund structure. So do you find it working? I mean, you have 2,500 units. Do you have any clue as to ballpark how much capital you've raised in your venture so far?
About 50 million.
Okay, so you've raised 50 million, which you say so calmly. It's just incredible amount of money. So you've raised $50 million. You've gone and acquired 2,500 units. At this point, you have funds, you have syndications. Do you have a preference as far as how you allocate the capital? Like for me as an investor, personally, if I were to invest in somebody's fund, there are pros and cons because it's diversification. It's like putting your money into a mutual funds. Most people know mutual funds, right? They go out and buy different stocks, and instead of just owning Apple, you're kind of diversifying your portfolio. But at the same time, I'm also wiring you capital with not really being able to see the exact deal that you're buying. So maybe having capital at the ready is a fund, or what have you found as far as investors feel more comfortable doing?
So I find that most investors, well, there's a difference, right? I'd say high net worth investors are like accredited investors that, usually have, say, a net worth up to maybe 10 million or so. I find that bucket usually targets individual deals, whereas for those that are getting closer to the ultra high net worth, they usually prefer funds because they don't want to have to do all of the work of looking at the individual deals. So when it comes to the majority of our investors fall under the former bucket of probably max of 10 million net worth. I'd say that's the majority of our investors. And I find that there's a draw to the individual deals. I think it's because it's tangible. You can see it. You can see sort of the return profile in it. And I think a lot of people think that they're going to be able to pick the winners, which really isn't always the case, right? And now sometimes it is, right? And I do respect, as an investor, especially me being someone that's so involved in this day to day, I do like to see the P&L and really get a good sense as to the asset and the price point, and make sure I'm generally comfortable with it. But I don't think there's a right or wrong answer for deal versus fund. I think it's very dependent on, one, the investor and how much time they have to allocate towards being an investor, towards the diligence and the upkeep. And then two, I think it's very dependent on the asset class. I think if you were to look at mobile home communities a few years ago, I don't think you could go wrong with the fund because the cap rates were so high, and it was really a function of timing and how do you deploy capital and get diversification and that kind of thing, right? I think if you're in, say, multifamily right now and today, right, I think individual deals probably a little bit more attractive. It's just my personal take, because you kind of want to really be picking and choosing because it's such a competitive, tight market with so much capital flowing in. So I think it depends a lot on the risk profile of the asset type. Depends on the predictability of the asset type. It depends on how much capital you're looking to place, and so there's quite a bit to it, right? A fund definitely does require an additional layer of trust because you don't have the tangible deals in front of you, so you have to really feel comfortable that you trust the operator to be disciplined with how they're deploying that capital. But it's all pros and cons, and also the fund is one of the big benefits to a fund is that your returns, your waterfall, which is meaning your preferred return, which is the initial money that is owed to the investor, all their initial money back, plus usually a certain percentage, usually 8% is very common. That is a blend of all of these deals, right? So you're having a waterfall that effectively is reliant on the overall performance of several different deals, whereas on individual deals, if one deal goes south and they have other deals that are performing and they're getting profit share on it, is maybe the incentive might not be there as much for them to take care of the deal that's gone south, or maybe that was the first deal you decided to put money into and you missed some of the higher performers, right? So there's just so many pros and cons to it. But I think it's all about the operator first and foremost, and it really is a trust thing. I think if you're not fully, I think if you don't fully know the operator and have that trust established, probably individual deals may be a great way to kind of test the waters and see how comfortable you are and how they perform. And then once you've seen them enough and you feel like, okay, this guy's disciplined, there's a big enough opportunity set to deploy a fund in a reasonable time, and I trust that they're going to do the right thing, then I think a fund can be great. So.
Yeah, that's such a great, so many good nuggets there, if you will. And I was doing some research and listening to some of your other podcasts that you did. And I know that you got started. Vinny was helping you out, and he's a big, huge hotel operator. And now you're doing, it seems like at the time it would have been more reasonable for you to get into hotels or get into multifamily because that's what you started out doing and learning doing. I know your story, and it's a little bit in here. I talked about it, how you dropped out of college and basically moved, and you're willing to move, and really just pure hustle and pure risk. I don't think many people are willing to do that. And for me, and I can relate because I took a one-way ticket to Paris Island to the Marine Corps. I had no bags. You got to go for it. So I think that's so important to get started. But can you talk about how you found RV parks? How did you get to that transition? And you can go back as far as you'd like.
Yeah, sure. So, like many, the first place I started was single family rentals, invested into some remote properties in the Midwest, just looking for cash flow. And that's really all I knew. And, the was eventually sold those properties and rolled them into a multifamily property. And then I was able to um, get into my first multifamily deal, 21 units with a few partners. And um, I really put myself out there, moving out to the Southeast and really going all in on trying to build my own syndication business, call it, focused on multifamily in the Southeast, and built a large network, did a lot of events, and eventually was able to link up with some partners that had an existing portfolio of give or take, I think 800 or 900 units at the time, and they had existing property management infrastructure, and we just hit it off. And we saw an opportunity for me to come in as sort of the young, hungry sweat equity to help find deals, help pull together investors, and help with the asset management reporting and things along those lines. And my partner really ran all of the day-to-day property management and saw through the execution of the deal. So that was a great starting point because it had the backing of some experience on my side, and learned a lot in that process. So started off in multifamily, spent 3 years there, and then partners and I went in a different direction. We also were having trouble really making sense of a lot of multifamily deals at that time. So it just seemed like we decided to go in a different direction. And around that point in time, I had some friends that had done super well in the mobile home park world, and um, I they were upset that they couldn't find 15% cash on cash anymore, and in multifamily you're lucky to find 6 at the time. So I said, look, if you can show me how to find 10, once I understood the underlying risk reward profile, I actually viewed it in some ways as less risky than a lot of multifamily. So I said, this just doesn't make sense, and this is a great opportunity. So really jumped in and moved quickly into the mobile home community world, and that's when really founded TRG, or Equity. And so I was able to translate a lot of what I knew from multifamily pretty smoothly into mobile home communities, given the especially the first communities we took on had a lot of park-owned homes, so they functioned a lot more similar to apartments, where the staffing is similar. You have same amount of maintenance guys for the most part, same kind of processes for the community manager. The only difference being is that generally our goal is to sell the homes off over time to be able to convert it to a tenant-owned home community. So we did a lot of that. And that it was somewhat of an organic fit because I had a really good feel for the numbers already. Of course, there was learning lessons, and the subfloors in mobile homes are not nearly as durable as those in apartments, right? And they can be fragile, especially as you get into older homes. So we had our fair share of headaches, but thankfully the pricing we purchased was forgiving enough to allow us to work through that well. And then we kept growing in the MH space. And then when it comes to campgrounds, the first campground we found was in one of our existing footprints, where we had 3 existing mobile home communities with a few hundred units. And we saw this it was right on the water, and it functioned with all 12-month leases. It was 100% occupied, all long-term 12-month leases, pretty steady. And I said, actually, no, sorry. The first one we bought is actually half MH, half RV, and it functioned just like a mobile home community. 100%, kept really, really high occupancy, and kind of got us a feel for like the ins and outs on booking, the campers. And then the first pure play RV was about 140 sites, and it was all long term. And we said, well, we feel pretty comfortable with this. The biggest difference, we learned is that there is certainly more turnover. You do have to be prepared to take on some short-term bookings to supplement the income while you're working on the long-term lease up, if you want to maximize the revenue. And there's more of an event hospitality aspect to it, right? People, in this case, this is more of what many would call a seasonal campground, but it's open year round, where people are really using this as their place to go on the weekends. It's like a second home. They all live within a 2-hour drive radius. Most of them don't live there, and they're going there on the weekends, and they raise their kids there, and they go to our events. They like live music, food trucks, things along those lines, right? And so that was our first step into the campground space, and then we continued on, and we have gotten into some that have a little bit more of a transient component to it, which is more like hospitality oriented. But we sort of, it's all building blocks. Like all of these skills and these tools sort of just built one after the next and kind of organically pushed us in this direction where we had the comfort level to enter into some of these more nuanced property types. But even today, our bread and butter has still been more of the long-term RV campground, like that seasonal. We love like waterfront campgrounds with a lot of annual stays, good enough size to be able to afford a decent on-site team to be able to, give the guests a great experience. And that's how we found our way into it.
Yeah, that's incredible. It's so funny because I remember we were tweeting back and forth because I do short-term rentals, the 26 unit midterm rentals, and just the amount of turnover and logistics that was actually a big mistake that I don't want to say a mistake because I've learned so much. None of it's a mistake. Even if you lose, you win in the fact that you learned something really important. But it's 26 units, and I am the plumber, the leasing agent, the doing turnovers, the just everything involved. So having a big enough deal, like you're saying, and the stability of 12-month leases, not only do lenders like it, but from I don't want to say it, asset manager perspective that you're in, you like that the income comes in every month. It's not as fluctuant as, like, for us, we crush it in the summertime. In the wintertime, it tends to get like few break-even months. So there is a lot of swing. And I know you own a lot of assets in this area, but I want to bring you back to when you owned 800, 900 units with your former partners. That's a lot of units. And most people listening probably don't have 800 units, myself included. So how do you guys part ways amicably, like, hey, I'm going to go do my own thing? Or how were you able to transition?
Yeah.
How did you know when to go do your own thing? You know what I mean? I guess it's not a
Yeah. We can touch on that. But first, before I hit on that, just to even take a step back, I think a good message for someone starting off, it's when you're in the position where you have control of everything and you're doing everything, it is a lot of work, but it's easier to perform really well, right? Like I think that what happens is, like, the short-term rentals, I'll admit, are probably my least favorite part of what we do management-wise, because of the amount of moving pieces, the amount of technology, the amount of kind of managing your reputation and all the OTAs, and you just have. And I'm saying short-term rentals not on the sense of RV short-term rentals, but like we have over 40, 50-ish cabins where they're all scattered throughout, and we run them on all of the major booking platforms. I think I can go on with a list of reasons as to why, but I'm sure you're well familiar with those. So I would say that's it's very tough, right? That's why I think owning one Airbnb, is great, and you probably can be the best host ever because it's your only side hustle, right? Call it, for some people, and they can spend their nights going directly, being the one communicating with the guests. It's when you have to start building a team to execute on all these functions and trying to delegate and trying to divide and conquer. It gets much more difficult, right? And that's where you have a lot more margin for error and a lot more sort of quality control that needs to be in place to be able to sort of manage these things at scale. And and we're still small relative to many, but I just think that's a message worth knowing. And that's the same thing even for transient campgrounds. Like, part of the reason I don't transient campgrounds aren't my bread and butter when it comes to campgrounds is that I think you could, if you owned one and you lived on site, like a lot of like mom and pop operators do, you could run the best campground ever and probably really maximize every little nook and cranny of it. But when you want to step back and think about, how do I own 30 of these and manage them all super well? just the amount of people and the amount of the right people and the amount of process and the amount of oversight to be highly effective. It's very difficult. It's not nearly as straightforward as when you run more on longer term leases, right? So a lot of that, what I mentioned, those things, is not that it's a bad business. It's just it's a tougher business at scale, right? It might be more profitable on a one or two off basis, but when you start to really think about scale, you have to think about the fires that are going to come along with that. So I just wanted to hit on that because I think that's an important point, starting off for people to think about, like, it's all about your goals and, if you're doing this as a one-off or if this is going to be something you really want to try to scale. Then when it comes to the, on the partnership side, it was actually fairly straightforward because, in that case, my partner ran like all of the property management operations, and we had someone hired that was already familiarized with how to handle the investor reporting. And we had a slower year, probably hadn't done a deal in almost a year or so. So timing wise, it actually was very, very smooth of a transition. And then it kind of freed me up well to be able to refocus and try to figure out what my next steps are going to be from that point on.
Yeah. So another thing that you said, Dylan, I want to ask you this. You said coming from apartments into mobile home parks at first, and then you kind of grabbed a RV park that was already where you kind of had a footprint. Maybe you had some contractors and really a presence. How in the world are mobile home parks less risky than apartments? Because I think the average listener, when you say that earlier, is like, I used to be a mobile home park broker. That's actually how we connected. But so I could go off on that, but I'm curious to hear your points. How is a mobile home park less risky than buying apartments?
Yeah, several reasons. So one, you're buying at a higher cap rate, which means, that's not, maybe that might not even be the case today anymore. I think that delta is almost gone, but that was there. So you always have a little bit more cushion on your cash flows and a bigger spread of your debt service. But two, the average, when someone owns their own home, the average turnover is every 15 to 20 years. So they're generally going to stay there for 15 to 20 years on average. In an apartment building, you're usually targeting around 2 years on average, right? So you have so much more turnover, which means there's always risk within leasing, marketing, changes in the market, and so on. They're price sensitive, but it costs a lot to be able to move your home. So that's part of why they stay there for so long, and also part of why, when it comes to increases on the lot rent, they're more durable in many ways, more sticky in many ways, because to pay an extra $35 a month or to spend $5,000 and move down the road, it's a big trade-off, right? And some people take advantage of that, which is a risk to the industry, and where regulatory risk could come in down the road, et cetera, right? But that's the case. And then when it comes to the capex, right? The majority of apartments in our world that we've seen trade in the last decade have been a lot of these B and C class, older vintage apartments, and majority of the time, the rule of thumb that you'll see on a broker package or most syndicator packages in terms of their replacement reserves is probably at least 5 times too low versus what the actual ongoing needs of the property will be in order to effectively maintain it and keep it up to even just its current status, because of all the infrastructure needs. Whereas on mobile home communities, you have the homes are generally owned by the residents themselves, so they're responsible for the ongoing maintenance. So you have minimal capex. And then the last thing that comes to mind, and it's probably more, but is the supply and demand. With the apartment communities and growing in hot markets, just recently we've seen I believe it was the biggest boom in apartment development since, I want to say, the 1970s. It might have been the 80s, but in the last 30 or so years, we've seen the biggest uptick in development, as we saw some of the rental growth, make it more attractive to start to build. Whereas with manufactured housing communities, to build these, you generally it generally either doesn't financially make sense to build them, the cost to build and the numbers just don't pencil. And in the areas where it does, it's usually you have not in my backyard protesters that are going to fight you and not allow you to build. So you usually have a shrinking total supply of MHC year over year, which obviously from an investor standpoint is an amazing thing, because you have an increase in you have an increase in demand in affordable housing, but a decreasing total supply of what is arguably the most affordable form of housing. So I think all those things combined is really what gave me that light bulb moment where I said, well, it doesn't make sense that these things are trading at a much higher cap rate than C-class apartments or something like that.
Awesome. Yeah, great answer. Why haven't me or you or anyone ever seen a mobile home park development? We see so much going on right now with new apartments being built. Why aren't you a mobile home park developer?
I would love to be a mobile home park developer. The challenge I see is, and there are people developing, right? I've talked to several people that are developing now, and I've heard a lot about development. So I don't drive around and see them where I am. So the challenges with development is, one, the all-in cost is a lot. By the time you get approvals and you finish all of your horizontal, you then need to start to think about bringing the actual homes in, and then you have all these carry costs associated. You have the moving costs of the homes, then you have the setup costs of the homes, then you have the carry costs of the homes, and then you have to hope that you can sell it fast enough and find qualified enough people to be able to purchase the homes. And don't quote me on this, because this is not a number I came to the conclusion on, but I've talked to institutional level developers that have found it could be $70,000 to $80,000 to develop a mobile home community site, right? And then when you talk about another 15 grand on top of that to be able to bring the home in, perhaps, and then the home itself is going to cost, I don't know, 70, 80, right? And then you have to sell. So your all-in basis is pretty high at that point. So in order to, if you're going to be building at, let's say your all-in is 80,000 per site, then that means that you need to have lot rents, I would imagine, of minimum 650, could need to be higher to be able to make financial sense of that. And those lot rents, I mean, they're here in Tampa for sure, right? But they're not going to let you build in Tampa. You really have to find really select cities throughout the country that will allow you to achieve the lot rents high enough to be able to justify development. Now, again, I'm just quoting what I've heard from more experienced people when it comes to development. And I know that there's people, I'm sure there's guys out there that have figured it out for cheaper and are going to make a killing doing this. But I know that generally seems to be the roadblock.
Yeah, it's a lot there, a lot of problems, a lot of different challenges that even apartment builders right now are facing, especially with interest rates where they are, and it's 2024 now. I want to transition a little bit about talking about the exit first. Many investors talk about how they're going to sell it, or before you build an apartment, you certainly have an idea of, hey, I'm in and out. I'm a developer. I just build it and then I sell it. Mm-hmm. So it's really important, and it's widely talked about in the industry. When you get on the highway, you got to have multiple exit strategies. I'm going to read a tweet that you wrote here. It's the best strategy is to buy, add value, refinance, and hold forever. Where did you come up with that mindset, and is ultimately with the portfolio that you're building?
Yeah. So I preface to say that hold forever is not something I'm married to, but generally speaking, my strategy is to buy something that I can, be able to generate good enough cash flow to eventually be able to get the yield on cost high enough to be able to pursue a refinance and then return a lot of your capital. And to me, I think that model is so tax efficient, right? Because you're going to get losses on the way in if you have bonus depreciation, and then you're going to be able to refinance and pull out a lot of your equity, tax deferred, and then you can go and reinvest that capital and then continue to cash flow that asset. And I think if you're in a growing market, right, you can hope for long term appreciation that takes place. Now, the only times I don't think that makes sense is if you don't believe in the future potential of the market. Say you think the market's going to be overbuilt and you want to get out before too much competition comes in, or if you think the market is declining in population, or if you think the asset, the ongoing capital needs to maintain the asset are going to outgrow your income growth. Right? There are definitely times where it would be stubborn to hold forever if it really truly isn't the most financially sound thing to do. But we usually go in with more of an indefinite timeline with the objective of refinancing to be able to return all the capital between the cash flows and the refi by year 5, and then continuing to hold for long term growth potential, especially because most of the deals we do in MH and RV are fairly low capex requirements. So it's a really attractive asset class for that. And I don't know exactly where I developed that philosophy. I think I've read a lot of Warren Buffett and Charlie Munger, and maybe that had some influence on me with kind of the looking at things as like from a long term perspective. I've also seen plenty. We've also purchased and met plenty of the guys in real estate that have been holding on to properties and they're in their 80s and they're sitting on $100 million asset that they bought in their 30s, right? And I think just having seen that enough times play out, it's always motivated me to say, well, since you're doing all this work to acquire a great asset, especially if you can find a way to take your initial chips off the table through refinance, then why not ride it out and continue to get the momentum and find additional assets to purchase. So I don't think there's a right or wrong answer. I know plenty of people can argue the fact that you might have a higher IRR if you're cashing out every 18 months and finding the right replacement for it, but that's always resonated with me. And also, I guess part of it is, I think, with an operator lens in place, right? So operationally, the more scale we get in any given market means that the lower our operating costs get. We get better deals on insurance. We get the ability to have more specialized roles in our team, to have better overall performance. So I view it as our operating performance is definitely higher as a result of having scale, especially in particular markets. And then down the road, if you do want to exit, and that's definitely a possibility for us, is that we may build up a large enough portfolio where we can sell it at a compressed cap rate because there's a large institutional player that is willing to pay us a cap rate that we just couldn't say no to, and we can then look at a 1031 or something along those lines, right? So I think the exit generally gets better when you have scale as well.
Yeah, that's great. Just like you get insights from underwriting 100 deals, I've gotten a lot of insights from following you and looking at your deals that you buy. I get the blast. I almost invested in a deal. The timing just didn't work out for me, but totally would invest with you if there was anyone out there running a syndication. Honestly, I think
I appreciate it.
I don't know how many hours you work or if you sleep, or if you feel comfortable talking about that, but it's got to be remarkable. I remember texting you probably a year ago. It's like a weekend. I'm like, are you working? And you're like, yeah, but I'm kind of like 50-50 right now. Dude, you are always like doing something or manifesting something. So
yeah, I mean, the last 3 years it's been last 3 years since we started this company, it's really been nonstop. Mostly 7 days a week. I don't know. I don't like, I'm not trying to like flex about how much I work, because if anything, I view it as that it's probably just a sign that I'm not the most effective operator with my time yet, right? And I'm making up for that by putting the extra time in until I learn and I have the foundation built to be more effective with less time. So I think that's how I look at it right now. Is I'm still in the early stages, kind of like earning my stripes, putting in the extra time, learning what I can, getting the right team built, the right process built, and then I expect that another 3 years from now I'll probably be having a little bit more of a normal working schedule when I feel like I have a lot of the foundation working for me at that point, right?
Well, you're young, and I guess I'm young too. So everyone says you always want to do it when you're young. So going back to my
Totally.
insights, though, I was going somewhere with that. It looks like you're buying, like, seems like one of the common denominators, what I see you guys doing is you're buying high quality assets. Some people call them trophy assets. It makes sense because you just talked about buying assets that have low capex, meaning you don't have to replace the roof every 5 years. You don't have to replace the cabinets every 8 years when the trends change. Is that one of your founding philosophies? Or, I mean, anyone with common sense would say, yeah, buy high quality assets, but it
Yeah.
seems like you're.
That's a good question, and I've had other people say that to me before too, and I usually scratch my head a little bit, but I think quality is all a matter of it's subjective, right? Because you and I have seen enough in this industry to know what low quality can look like in this industry.
Yeah, it's
It definitely wasn't in. I mean, um, I'm all about the returns, right? And I'm almost agnostic to, um, the way it looks in terms of what it takes to get there, right? To me, like it really is about the returns, and we've offered on high quality stuff, we've offered on low quality stuff, but it all gets factored into the price. The workload it's going to take to execute gets factored into the price, as in like the inherent risk on a turnaround deal or something along those lines. And what we've put together has sort of been um, what's made the most sense for us, right, with our operating costs and our general strategy. So, I mean, by all means, I would gladly, I don't ever like to think that I like stretch on the numbers, but I would say that on a lower quality asset, like I um, it just needs to be like a real no brainer. Like the upside really has to be, commensurate with the quality. Whereas like I may be comfortable with us targeting a slightly lower return for something that's higher quality because you may have a better exit, or there may be better rent growth while you're holding it, that kind of thing, right? So that I think I try to take a very like holistic approach, and I almost want to put a lot of the thought process down into paper right now and try to like think through what are all the different things that we place weight on. It's something that we're working on right now, but it's really just taking like a holistic approach and just finding like what really gets us excited, what really feels like the returns are commensurate with the deal itself and that kind of thing.
Yeah, so if you're mostly focused on getting yield for your investors, for your group, for your company, how do you stay within your lane? Like if somebody brings you a hotel conversion, you know, I'm sure you see all sorts of stuff, but there's a lot of no's, I'd imagine. Um, how can someone get started who sees everything as an opportunity?
Yeah. Yeah, that's a great question. And I mean, for me, one critique of me could be that I've already, been in 7 years, I've been in three different, asset types. So, but I promise you there's been a lot more no's than yeses to wind up here. It's just sort of how it's worked, and, following where we have high conviction and where we see the right opportunities. And if you kind of look at it all, they're all somewhat similar. You're all serving people. You're staffing it fairly similar. A lot of the procedures are very similar. There's just nuances in a sense, but yeah. I mean, I do tend to see there's opportunity in so many different areas, but I like a hotel conversion to me sounds like just a headache that wouldn't be worth it. Like just the amount of time going into trying to learn that model just sounds like a total headache, and I don't think I'd have interest in it unless I could have a cushion on hitting a 40% IRR with my eyes closed, right? Like, but I don't
Yeah.
think that's likely, right? Because someone that's more experienced is going to go in, they're going to buy it, and they're going to be more competitive, right? So, what I would say as well is, when anytime I've entered something new, I've had to have that extra margin of safety, right? Like my first apartment deal, my first mobile home community, my first RV campground, they all did exceptionally well, right? And like I was extra cautious, right? Because you don't know what you don't know, so you need to bake in so much, conservatism into those numbers and those assumptions, because why wouldn't you? It'd be silly for you to be coming in aggressive on something that you're really, you don't know about, right? Once you have enough operating history where you can kind of see what your historical averages are on your expenses, and you have a better pulse, then you can try to be a little bit more realistic, perhaps, on like your target, your assumptions that you're using, and therefore you can get more competitive on pricing. But I think anytime you're looking at something new, definitely just being extra cautious. I think that's super important, because you'll hurt your credibility a lot if you're not doing that.
That's great. Yeah. So I want to transition to like the last handful of questions that I ask all of our guests. Really curious on this one. So we're entering 2024. It seems like a reset, really, with artificial intelligence, people getting burned based on interest rates. They bought bridge debt, which I know we didn't talk about it, but I know you're a huge proponent of fixed debt long term. What do you think interest rates have done to real estate? And if you were getting started today, where would you be looking?
Yeah, if I was getting, well, I'll start with the interest rates. Interest rates going up has made transactions very difficult. Honestly, I was hoping for more pain by now in the MH and RV space. Not that I wish pain on anyone, but I thought from an acquisition perspective, maybe this is going to really open up the door, and there's going to be, a big price adjustment and some attractive buying opportunities. And MH specifically has stayed super steady on pricing. I've been amazed. It's been probably the most resilient asset class when it comes to pricing. RV has gone up a bit cap rate wise, due to mainly, I'd say, due to the banks increasing their spreads. So banks have increased the spreads, at least like probably around 100 basis points over where they were. So with the higher rates, it's not only that they're getting higher rates in line with where the market's gone up, but there's also an additional spread. So that's made the cost of capital much higher, which has definitely hurt the RV space temporarily. I mean, hopefully temporarily, but we'll see, right? But it's hurt changed pricing in the RV space. But I don't think a lot of buyers have, or sellers have, really capitulated yet and like come to terms with the fact that their asset isn't worth what it was in the golden years for the last few years. So we haven't seen as much transaction volume, but it's starting, definitely. And then obviously multifamily. Multifamily, you're seeing. I don't track it as closely. We do still underwrite quite a bit of multifamily, but we haven't. Besides a few like smaller local projects, we haven't been super active. But we track it loosely and follow deals in very specific markets. And we definitely have seen the biggest price adjustment starting to materialize there. And that is not because the fundamentals have really changed that much. I mean, there has been a lot of new development and so on, but it seems more so just because of a lot of people on floating rate loans. It was a very much like fix and flip business for the last 5 to 10 years of people going in with the plans to renovate it on a bridge loan and sell it in 2 years. And I think that's for those that were midway through that, I think that really has backfired this go around. So I think you're starting to see more deals trading at with a complete equity loss there. So it's crazy to see that. If I were getting started today. Yeah, it's a good question. I mean, it depends on how much capital and what I'm targeting. If I'm targeting a personal investment, I would target a small mobile home community, um, or small multifamily. Probably that's local to me. I think smaller campgrounds are a little bit tougher to manage. So like that's where scale comes into play. So to me, the bigger ones usually start to make more sense unless you are passionate about it and you want to be in as an owner operator to get started there. Or you see the ability to develop, then I think that makes a lot of sense. But if I was just going after an acquisition, I'd probably start with a smaller multi or a smaller mobile home community, because there's still more price inefficiency in the smaller deal sizes, say like the 500K to maybe up to 5 million. But definitely, in that kind of size range, I think you find probably the most price inefficiency. And then, something that local is always nice if you're in a good enough market, that you can kind of be hands on and either manage it yourself or get a third party that you can be close with. And I think that's where I would start. I've never been a fan of like fix and flip. I don't know, just never resonated with me with like the risk reward and the work that is required there. And
Time.
yeah, it's a lot of time, right? We're actually doing hard money lending to local fix and flippers. And we are doing hard money lending as like bridge lending for MH and RV right now, just because the equity deals have been a little bit more scarce. So we are getting more into the lending business. But so I mean, I think it's great for those that have the process down, and I know some guys that do tremendously well with it. I'm just speaking for me personally. It just hasn't really been. It has never really drawn me to it. It feels more like a little bit more maybe transactional. Whereas like I think I've always valued the idea of like putting all the work in up front and then having something that's going to continue to pay you once you've executed on it. So that's my take.
Yeah, that's great. I mean, a trend, I have a ton of friends that do fix and flip, and they think that they're just going to hit one so big that they're like never going to have to work again. It seems like it's so transactional. Your capital is out there for so long. So it's really not an advantageous business. For the longer you hold the property, the more walls you open up, the worse it gets. And it's like this idea that, forget who said this, but it's like you're never going to sleep so good that you're not going to want to sleep again. And I feel like, like, or you're going to like eating, right? It's like you're never going to like eat so much that you're never going to eat again. Like you're going to be hungry tomorrow. So you're never going to like hit this home run so much that you're not going to worry about it. And there's a lot of
Totally.
talk about on Twitter about this, about not raising capital. Like, so you start out syndicating deals, raising capital, with the end goal being to do deals by yourself. It seems like you and your company are totally taking the investors for the ride. Is that fair to say, or what's your long-term growth? I know we talked a little bit about exit, but it seems like
Yeah.
you're
Yeah. For the most part, I still have a few deals that I have, large piece of ownership in that haven't been syndicated. And, that to me, those deals have given me cash flow to live off of, really.
yeah.
Right. Well, I've been growing the investor business because a lot of our business is very delayed gratification. So, thankfully I've had a handful of deals that have, given me the personal, financial position to be, comfortable that I could live off. But, that allows me to be more patient to really pour in and growing and scaling the investor built business. And the long-term goal, for me, it's not necessarily, I actually really enjoy working with investors. It's been, we have probably 190 investors, and it's been very little headache. And there's something I enjoy about reporting to them, the relationships I've built, and so it is something I definitely value. But I think it's probably more so. I think that the goal is to get to where where I'm not having to work around the clock, just to execute day to day. And if I do work around the clock, it's because I'm doing it purely by choice versus feeling required to because I want to perform and execute on everything that we've set out on. So I think it's really, about getting those, it's not going to take a ton, but just getting like the few key team members, right, like building out like the strong leadership team, which we've come a long way on, and getting to where, like, I can really get the business to where, if I were to take a month off, which I've never done in my life, but if I were to do that, then I'd be able to come back and things would be still running smoothly, right? So I think that's probably the bigger thing of just to mentally free myself up to be saying like, okay, I'm doing this now out of from more of a place of abundance, and not because I'm needed here, but because I just love chasing the next deal or whatever it might be.
Yeah, there's definitely something to be said about that. It's just why old people are still working. They're the wisest people in the world, and they're still working. And you look at a lot of these successful investors like Warren Buffett, he still lives in his house that he bought in 1970s for 80 grand or whatever it is. And you made a tweet about having sold everything. You bought, I think it was like and one socks and $5,000 car or something.
Yeah, I'm still driving that. I so I haven't.
That's awesome.
Haven't spent too much. Yeah, I've been living pretty frugally the last few years. I mean, I've invested a lot into the business though, right? And we've hired a lot of people, and we've got an office, and so I mean, we definitely have increased the overhead, but it's mostly like business related stuff.
That's incredible that you've been able to delay the gratification, because I don't want to say I know what you make, but if you've raised $50 million, you can definitely afford to drive a better car. I know you rent. I know you walk to work. So you seem like a pretty bullish on delaying that gratification, which is something to be said about that. Is how many people would be living the way that you do with the net worth and assets that you do. So that's hats off to your drive, and I think your morals you're on the right path.
Yeah. I don't really have like, strangely, like I don't really have like a ton of desire to travel. I don't really have a ton of desire to like own a lot. But I do have desire to, build wealth and to, continue to buy other assets, to continue to, like snowball and, support those around me, and just have, the freedom that comes along with it. So, I think my big driver really is just, I think, the freedom, and that just, it's almost just like the more you do, the more you see you're capable of, and, just kind of like pushing the envelope on that side of things. And then eventually being able to, continuing to like hire out people to replace my time, right? Because I think time is the most valuable thing, right? Like if there's an area that I spend a lot, it's probably Uber Eats and DoorDash, right? But it's like, that's, to me, it's a no brainer because of saving time, right? And I'm able to get my Chipotle every day without having to think about food I'm ordering and stuff like that. So I'm all about that kind of stuff, right? Convenience.
Yeah, me too. As I got older and made a little bit of money, I realized and recognized the power of time. It's an extra $10. Is your time more important than $10, because you have to drive there? You're going to get stuck in traffic. You have to go sit in line. You have to order. And the higher you look up, as far as mentors or net worth people, is they're really selfish with their time, and you have not been selfish with your time today. So I appreciate it. So going back to my final three, I was supposed to ask you this, but just got so sidetracked, and you're just dropping such great information. So my first question is, does the deal come first, or does the capital come first? No right or wrong answer.
I would actually say the capital. Like if you don't have the money yourself, then you have to really be hustling to build those relationships and like show a thesis and show like what you're doing. Because the idea of like, I'm going to go raise $1 million and I don't know anyone, I've never done anything to have credibility in this space, like it's going to be very tough. So I would actually say the capital comes first. Even though there might be a way to get a done deal, if it's a really, really good deal, you might be able to find someone else, but they're not going to give you. They're going to take most of the deal for themselves at that point, probably.
Yeah, no, that's great. And that's a hot take. I feel like most people have said the deal. I would personally say the deal, because I found a Taco Bell deal that my investors wanted nothing to do with, and I was able to make some money off of it by just flipping the paper or signing the contract. So I'm
Right.
always hustling the deal. I know if I can find the deal, I'll be able to
If you
figure
find the deal,
something out.
the deal is always like the biggest asset, and there's a way to make money with the deal. But if you're trying to actually like syndicate it or have
Long
ownership in it,
term.
then it's tough. It's tough to just cold call someone and raise money on the spot, right? So
Yeah, that's great. Okay, so what are a few favorite books? Do you listen to books or do you read books, or what do you? Yeah.
yeah. I've always been big into Principles by Ray Dalio. That's a book that I've revisited several times now, and definitely one that I like. Just overall philosophy and the way that he thinks about like being an architect around the business and the culture and things like that. Trying to think if reading one on Spark, I believe it's called right now, which is just like the exercise and the impact on the brain. Um,
Do you read
but
any like nonfiction, or is it all like business analytics?
it's it's mostly all non. Yeah, no, it's mostly all nonfiction business type stuff. I haven't. Yeah, I really I'd like to read more. The last 3 years, I've read a lot less than I used to. I used to read like a book every week for a decent amount of time, but I'm pretty heads down these days, just grinding it out right now.
That's
So, but
awesome.
that's something I'd like to do more of, like when as I free up my time a little bit more.
Yeah, I started reading fiction just like before bed, and it's helped a lot because you rarely like unplug. And there was like a study that cigarette smokers and people that drink wine every night live longer than healthy people like you and me. And as it turns out, cigarette and drinking alcohol is really bad for you, but they actually relax. Like they
Hmm.
are just totally unplugged. If you think about it, if you like, how often do you spend 15 minutes meditating, and that every night that's your like wind down? So for
Yeah,
me
I
and
actually
you,
do
like,
try to meditate. That's one thing I've been pretty consistent with for like 8 years or so. Like 10, 20 minutes a day of just like simple transcendental meditation. That I do find that definitely helps me. And it's one of the things I
do you
do
do
try to
the
do.
like the Wim Hof breathing? Have you ever heard of that?
I know of it. I haven't done it in years. I think I learned about that at a Tony Robbins event way back. It was pretty cool. But I just do like a mantra based thing.
Okay, cool. I started doing the Wim Hof a couple weeks ago. It's wild, like holding your breath for a minute and a half, and like the benefits after. I started doing cold showers too, but I feel like the best advice I've ever gotten was just work. Like put your head down and work. There's not like if you get a cold plunge, you're not gonna end up being raising $50 million
No, I
because you
think
bought a
those things
cold
are
plunge.
great. I actually think it's very like dependent on the person. Like I think my body type, I think I've come to accept that like I'm more like I don't need the extra stimulation usually. Like I'm usually good. Like if anything, I probably need a warm like chill shower and to meditate. Whereas those things get you fired up, and like I got usually enough of that where I'm just like, so I think it just depends on the person and kind of like what you need to balance yourself out.
Okay, and my last question, which I think you've answered for us, but what are your hobbies?
For the most part, hobbies are I just like to go to the gym, try to go at least 3 times a week, lift, and that to me that's a hobby. I enjoy it, and then go on a lot of long walks. Live here in downtown Tampa, so always walking around the waterfront, listen to audiobooks, talking to people. Occasionally play some tennis or pickleball. And just hanging out with got a couple
Let's
friends
go.
locally.
I was gonna ask you if you played pickleball. I've been playing with some pros lately. I got into the group.
Oh damn!
I'm like very low on the totem pole. It's like everyone called out and they need somebody. So it's been incredibly fun and rewarding to
It's a
you
great
know
time. Yeah, I just got into it. I don't know, like a year or two ago, but it's a lot of fun. So
Awesome. Well, thank you. That's it, guys, for today. Thank you so much, Dylan. How can visitors, how can listeners get a hold of you? How can they get a hold of you if they're looking to invest, or what deals? If somebody wants to
Mhm.
bring you a deal, are you open to looking at it?
yeah,
How?
So you can visit our website. You can go to Requity, REQUITY as in general partner. RequityGP.com is our website, and you can opt in there for our investor form if you want to see we usually send out like a quarterly newsletter, and then anytime a deal goes live, we'll send out an update with details on that deal. You also can follow me on LinkedIn, and as you mentioned, X. I haven't been as active lately, but I get go on spurts there from time to time too. So definitely follow along there as well.
Good deal. Thanks, Dylan. I appreciate it.
All right. Thanks a lot, Nick. Appreciate it. Take care.
Really quick, while I still have you, I just want to say thank you for tuning in to the show of Real Estate Secrets. I hope you found today's insights valuable. If you enjoyed the show, please take a moment to subscribe, rate, and review your podcast wherever you listen to this. And last thing, I just started writing a private newsletter, basically highlighting the ups and downs of my current real estate assets. I share with you the numbers. I don't sugarcoat anything. And this is really where I can stay in touch with my investors and would love to have you on that newsletter. So the link is in the description. You can also find me on LinkedIn, Nick Chapman. And again, thank you for listening to another episode of Real Estate Secrets. Catch you on the next one. Peace.